Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey, good afternoon. This is Tech Talk Tuesday. I'm David Blake. This is your first time attending. I want to thank you for joining us. And we usually go about 20-25 minutes. We're going to talk about some of the charts and sectors, and then we'll open up to questions at the end. If you want to ask about individual stocks or different sectors or industries, whatever comes up, you can. You want to start out, last week was the broader market was up for 4 straight weeks. The Dow Jones tacked on about 430 points, up about 2.5%. S&P 500 gained just over 2%, and the Nasdaq spiked to almost 3%. The Russell 2000 continued to underperform, but actually last week was a decent week for it. It was up 2.1%. So off the August-September lows, the Dow Jones now is up about 12.6%. It's one of the stronger indexes. S&P is up about 11%. Nasdaq's up almost 17.5%. But the big cap stocks are leading the way higher on this pretty fierce rally off of the bottoms. One thing that's kind of interesting to note on the Market Edge weekly letter, the Market Edge Momentum Index has fallen over the last 2 weeks from a +4 2 weeks ago to 0 last week. And what that's signaling is that the Dow Jones is beginning to outperform some of the other indexes like the utilities and the Dow Jones Transportation, the Russell, the advanced decline lines on some of the exchanges. But we're also seeing the sentiment remains quite bearish despite the run-up, which is actually bullish over the short term for this market. Sentiment is a contrarian indicator, and we actually saw the bearish sentiment as we talked on some of these meetings a couple weeks ago actually reach extreme levels that we haven't seen in multi-years. So that tells me that we probably may have a little bit more gas in the tank here. But the big news last week was Mario Draghi coming in and stating that we're probably going to have a little bit more quantitative easing. That gave us the market a nice boost, I believe, on Thursday. And then on Friday, we also saw China cut its rates, which actually saw the Nasdaq and especially the Nasdaq 100 gap up on Friday. What we want to check right now is we're going to look at some charts to see if this over the last month or so is the real deal, or if last Friday's gap up may have been what some technicians may call an island reversal or possibly an exhaustion top. Okay. First chart we're going to look at real quick is the Dow Jones. As you can see over here, we've broken out above the 200-day moving average finally. Then we had a little bit of gap up there. Yesterday we had a little bit of a sell-off, came down and tested the 200 moving day average. Unfortunately today, midday, we're actually just breaking below there. The Dow's down about 48 points. It has fallen back below the 200-day moving average, which was an area of support or resistance that we wanted to watch. However, the underlying indicators, we see the on-balance volume up here showing a lot of buying coming in. RSI 14-day looks good. MACD is also confirming that the trend is up. However, we may have gotten a little bit ahead of ourselves, and the market is a little bit overbought. If you look at the weekly chart, we did climb back above the 200-week or the 50-week moving average on the Dow Jones. The on-balance volume isn't quite as intense as what it shows on the short-term trend, and also on the RSI, the 14-week, we're just seeing the positive momentum coming in after this rollover. It's basically crossing the 50 the point, and looks, but the MACD long-term still hasn't crossed over the bullish signal that we're out of the woods yet. We'd love to keep a little bit of an eye on that. S&P 500. We're back above the 200-day moving average on that also. The chart looks pretty much like the Dow Jones. A great double bottom off of the August and September lows to initiate this 11% move. We're probably back below the 200 again today. Let me take a quick look here. Nah, we're still above it as we speak right now. But the S&P 500 is overbought. We can actually come down here to around the 2015, 2025 area, which would be major support for this index. We're back in that trading range from that we've been in most of the last summer. If you look at the weekly chart on this going out over 3 years, again, you can see we're back above the 50-week moving average. It looks strong. We had a nice gap up here for the last 2 weeks ago, and right at this point, we're holding above that 50-week average on that. Also, indicators aren't quite as robust as they are on the daily short-term charts, but the RSI again is right here where if it crosses above this 50 level, it could signal a little bit more of a further run. Now here's the Nasdaq. This is another good chart, but there are a couple troublesome signs on here. Okay, this is up 17.5%, and I measured that from right around here. I didn't want to go all the way back because some of these ETFs and stuff caused us to open up a little bit lower. But about 17.5% move over the last 7 or 8 weeks. And what you see over here, after a move like this, to see a gap that high, that doesn't sit well with a lot of people. Now, a lot of that was due to the 10% spike in Microsoft, but a lot of times when you have a gap up like this, if we break down below this 5,000 area, there's a good chance that when you have a gap like that, the gap usually gets filled over the next week or so, and that could be happening. Now, if it does, all it does is bring the Nasdaq back down to the 200-day moving average, which would be bullish. It has a little bit of wiggle room below the 200 here for major support, but the unbalanced volume is supportive. You can see a little bit of some profit taking over here going sideways the last couple of days. MACD's bullish, and the RSI is back up here over 70. A little bit overbought. Well, definitely overbought on the Nasdaq, but I think that we really want to make sure that this thing holds. We're down 10 points today at 524. A break below 5,024, you could have some additional selling as people think it's overbought. Okay, here's the longer term, the 3-year report on the Nasdaq. Again, we're well above the 50-week moving average. It's bumping up against resistance in here at I think right around 50, 50, I think is the resistance on that. Okay, last index I want to look at before we look at some of the internal indicators. This is the Nasdaq 100 also, and surprisingly, this thing's just a chip shot from recouping the whole move down. This index is comprised of the big cap names in the tech industry. Names like Microsoft, Facebook, Amazon, Alphabet, Google, whatever you want to call it. And like the Dow Jones, it's outperforming as investors are currently just piling into the large cap names. I'm not sure exactly why they're centered on that, but what this shows is that the rally is, like it was most of the summer, is limited to a smaller number of stocks. When you look at the AD lines here in just a couple seconds, you're going to see that this isn't supportive actually of the broader market continuing higher. Okay, we look at this generally every week. This is a chart that can be found on the Market Edge homepage under Market Recap. This is a leading indicator of breadth. This is the Nysc Advanced Decline line. This measures whether there's more stocks going up or going down. Now, it's interesting, as it says, a leading indicator. When the market peaked back here in, I believe, May, the next 4 or 5 months while the Dow was trying to flirt with new highs, the AD line was continually working its way back. We had a nice double bottom in here, a strong move up off the top, and actually, it looks like we've actually gained about 12,000 units off of this bottom from over here. A lot of accumulation, the big names on the NYSE. Okay, we flip it over to the Nasdaq, however. When you talk about the Nasdaq 100 having a 17% move up off of that bottom, and yet you'll look over here off of the bottom that happened on the AD line for the Nasdaq in mid-October, we've added about 4,000 units. That's not what you want to see on a 17.5 move on an index. I mean, this thing should be up here around 318. We should have added probably 10, 15,000 units if this was a broad-based move. And that's probably the first red flag that we're going to see. This to me is actually kind of bearish of the move. It doesn't confirm either the Nasdaq's 17% move higher or the Nasdaq 100's 22% move higher. So to me, I'm still going to give this a bearish rating. Okay, another thing I'm going to look at real quick, another breadth indicator, which also is kind of a leading indicator, is the number of new 52-week highs and new 52-week lows. We finally have gotten back positive. For most of the summer, while we were trading sideways, the new lows were constantly beating the new highs. Even in up until just about a week and a half ago, the last 2 weeks we've had more new highs and actually about the last 3.5 weeks we've had more new highs and new lows. However, we're only in double digits on the NYSE. We had 130 last Friday, which was the first triple-digit new high we've had in quite a while. And we're still seeing about maybe yesterday was 60, 50, something like that. So that's not indicative of a strong, wide, broad-based rally. Now over here's the Nasdaq new highs, new lows. Again, we finally hit double digits on Friday, 141 new lows, 68, or 141 new highs, 68 new lows. But before that, you had months and months going back into July, where the new lows have been outpacing the new highs rather significantly. This day here, we had almost 800 new lows. So again, this isn't confirming that the up move off the bottom here is expanding and that we're having a broad-based market rally. It's telling you that this still is a thin rally, and it's something that is a red flag. Again, I'm going to put that also in the at least neutral at this point. Okay, another thing we talk about once in a while, and earlier we talked about the market sentiment. Still showed most investors and advisors we're still a little bit too bearish on the market. I read about this in Friday's market letter. We actually talked about some of these indicators that had reached levels that we hadn't seen probably since 2009. This first one is the weekly bull percentage of weekly bull advisors. This is how many guys are talking about whether they're bullish or bearish on the market. This had fallen down to 27.8% a few weeks ago, and that was the lowest percentage we've seen since March 2009, which signaled the end of the last bear market. You can see we're starting to see a little pickup in that, and being a contrarian indicator, this still shows there's too many guys that are bearish on the market. So we're going to slide this over into the bullish camp. Here's the percentage of bearish advisors. This also had quite a spike up. 2 weeks ago, this hit, I believe it was 35.1 or something like that. That was the highest number of bearish advisors we've seen since November of 2011, when we had I think that was the last correction of more than 10% with pull-off. So that still shows that we may have a little bit more gas in the tank, and the market could work its way a little bit higher. A lot of times I'll look over the different sectors in here. I just want to go over a couple of them right now. As far as the sectors go, the technology sector has been the best performer of the last 1 month. It's up about 10%. Telecoms are next, with up about 9%. Part of that is partially due to the high dividends associated with that sector. And then we have the materials up 7.7%, financials up 7.5%, industrials lagging a little bit, 6.6%, consumer staples, which just a couple weeks ago was right near an all-time high. It's up about 6.2%. REITs paying good dividends. They're up about 5%. And another leader was consumer discretionary. It's kind of backed off a little bit. We're only up 4.7% over the last month. And energy, again, still a laggard, up about 4%. The only negative sector over the last month was healthcare. It was basically flat. It's down about 0.18%. So you had some buying come into the healthcare sector last week, which gave it a little bit of a bounce, but it's still a beat-up sector. And what you're seeing here is mainly a bounce off of some of the oversold sectors. Okay, I want to touch on just a couple of them. I talk about the energy sector. This is going back to 2009. As you can see, we have kind of a broken chart. We broke down long-term resistance, came up and tested it. We came down here. This is the Fibonacci retracement numbers that you may want to look at. And this is a 62.8%, 61.8% of the total move from the 2009 high to the 2014 high, from low to high. And as you can see, we've already recouped about 61.8% of that. This rally took us up to the 50% retracement level, and we've backed off of that. We've had some pretty good selling on inventory buildup in crude oil, which is weighing on that sector again. That sector also is down today. We saw crude oil break down around $43 a share. That's going to cause some of these stocks to, again, come down here and possibly test some of the lows. So I've talked about a little bit of this sometimes. When you see some oversold levels like this and you buy some of these oil stocks, I think you're buying them right now for at least a half a position. You want to trade out of them when they get into resistance levels, which is what we saw a couple of days ago. If this would come down here and hold onto the 50-day moving average, maybe you can nibble away again for a little bit of a bounce here. But you see all the stochastics, we're way overbought on that. RSI is coming back down here. It's at 50, so it's showing a little bit of weakness. Momentum's kind of waning on this, although the up-down ratio moved pretty strongly here. So you did have a lot of institutions and stuff coming in and buying some of those stocks. Again, I would buy these on sell-offs and sell them on a trade at this stage of the market. Okay, another one we want to look at is the materials sector. This is another weak sector. Had a nice bounce off of the lows mid-month. Again, we broke a long-term trend line, which is bearish. We did get it back above the 50-week moving average, which is okay. But again, I would be selling some of these stocks, which this includes natural gas, copper, lumber, things like that, where you can, when you get the bounce like this, you want to go ahead and at least sell half positions. We are overbought again. If when the dollar goes up, that's going to hurt the materials thing, and we'll find out actually tomorrow whether the dollar is going up or down. Another one we'll look at, here's the healthcare spider. Again, the long-term chart shows it outperformed all the way up to here to the late summer. This sell-off in biotech and drugs mainly caused a lot of it's caused by finagling in Congress about drug price issues, and that's going to keep a little bit of a lid on this. I would have a list of good, strong companies that you like in in this sector, and buy when it falls down in here, especially if this XLV, which currently today is at around 70, it's up today 1.32%. When this thing comes down, I would be buyer of healthcare stocks. I think longer term you're going to be fine in these things. It's had the biotechs especially have sold off almost 25-30%. So that even though it looks weak on here, I would be buying dips in the healthcare sector on what we've seen. Okay, I want to pull up a couple other charts before we wrap this up. Number one, this is a ETF of the U.S. dollar. The reason I don't bring up some of the indexes is we still get a 98% correlation rate on ETFs and some of the indexes, and it allows you to actually trade some of these things that we talk about, like when we feel we're going to have a rally in commodities, which we got the last couple of weeks. The move last week by the central banks and by China caused quite a little bit of a spike over here in the dollar. I'm surprised that it didn't really knock the market for much of a little bit of a loop. I think people are kind of waiting till Wednesday, tomorrow, when the conclusion of the FOMC meeting. Depending on how dovish or hawkish Fed Chairperson Yellen is, you could see a movement in the dollar. If she, for some reason, comes on a little bit too hawkish because people were kind of beating her up for being too dovish last time, you could get a little bit move up in the dollar, which would probably be bearish for the overall market. Now we are right here at resistance on this is the UUP. It's got support down here, 2465, 2469. You can find on any charting package. You can pull up UUP to follow this. And it's got resistance up here, 2522, 2532. A move above, say, 2557 up here would actually be quite bullish. That could be trouble for the market and could trigger another sell-off. So keep UUP on your chart list, and that could give you a little bit of what's going to go on with a broader market. Now, I had a question last week afterwards asking me about gold. I'm neutral on gold in the longer term, but I think it does have an interesting looking chart over the near term. Again, if the dollar jumps up, that could put a little bit of a damper on this current rally. But you saw gold trade above a long-standing downward declining trend line. We're above the 50. We're running into some resistance right up here at the 200-day moving average. But if we can clear that 200-day moving average, I think you could get a pop on gold up to maybe around the $1,200 range, especially if we get some dovish comments and we see the dollar slide down a little bit. So I would keep a little bit of buy on that. Some of these stocks are down 30% or more on the gold shares, and I could set myself up on that. If you get down here, back down around 1,100, that would probably be a signal that we're starting to rally. They're starting to stall, but again, if we have a little bit of a rally right above this part of here, we could get a little move to about $1,200 an ounce. Okay, the last one I want to look at real briefly. Yesterday we saw a big drop in natural gas. Again, that was on the oversupply. It looks like it got clobbered yesterday, making multi-year lows. I'm not sure where the bottom is on this. If you haven't locked in your heating rates this winter, you might want to wait on that and just go month to month. But there seems to be an endless supply of natural gas right now. We're below the 250-day scat. We are oversold, obviously, but RSI is still bearish on this, and the up-down ratio down here at the bottom, you're not seeing any accumulation in this at all. Okay, the last thing I want to show you, actually, let me go back to this. Okay, last thing I want to say before we get to some questions, I want to leave with this. October was pretty wicked as far as the broader market went, up 4 weeks in a row, but it was a split market. First off, we had buying going into the overbought sectors and stocks, which is pretty normal for an oversold market. But you want to see that when the economy is improving. Okay, with the Dow Jones up 12.6%, comprised of big cap stocks, and the Nasdaq being up 17%, that is not quite what we want to see in a broad-based number. The Russell 2000, if you look at that, is actually the Nasdaq. The Russell 2000 is only up about 8% on this whole mess. And the number on the advanced decline lines, what we talked about earlier, we're up about 4,000 units on the Nasdaq, where the NYSE is has added about 11,000 units off the bottom. We're right in the middle of earnings season right now. So far they're beating lowered expectations. Economic data seems to be decelerating going into the fourth quarter. This morning we had durable goods orders for September came in at down 1.2%, and August was revised down 3%. Now, often you'll hear me talk about the Dow Jones Transportation Index being one of the key factors in how long a rally is going to last and how strong it's going to be. And today we're off 220 points as we speak. We're down 2.6%. The railroad stocks and the trucking stocks are getting hammered today. They're off 2.5% and 3%, which is not what you want to see for the market to be working its way up to new highs. That's another red flag. In addition, this morning we saw consumer confidence. They were looking at coming in around 103. It was a big miss. It came in, I believe, right around 97.6. That was a big miss. We thought, with the lower gas prices and all, the consumer would be getting a little bit would be feeling a little bit better about itself. It's kind of rolling over. Okay, the market got a big boost last week from central banks. I think, we'll probably churn a little bit to see what's going to happen with the FOMC meeting tomorrow. If she's dovish, there's probably a little bit more of a move up in this market, but I would begin to sell off some of my positions, even in the big cap names that are running up the Facebooks and some of these. You might sell half the positions and look for a pullback, probably going into mid-November. I'm still cautious on whether or not we're going to have another test of some of the lows, but over the short term, I think you can go ahead and hold this a little bit and look for look for the start to sell off as we run into resistance. Okay, I see a couple questions that are coming up here right now. Let's see here. Okay, the first question we want to go over, last month you mentioned getting into defensive stocks like Procter & Gamble. How is this playing out? I still like some of the defensive stocks. In fact, I'm going to switch over so we can get in, so we can look at some of the charts on these. Let's see, hit that. Okay. You just give me 1 second. Okay, XLP, which is the consumer staples. Here is that chart. Let me go up to the 1 year. And let's do the daily. As you can see over here on the consumer staples, this is a line chart. We're almost back to the old highs on this. I do like this sector. MACD looks bullish. In particular, somebody mentioned Procter & Gamble. I said I would start to be buying that in here. It wasn't one of my favorites. We've had a nice move in Procter & Gamble over here. I'm going to go to the candlestick charts on this. As you can see, we had a gap up here last Friday. We're looking at this probably running into the mid-80s, I would think, with Procter & Gamble. It's got resistance up here between 80 and 81. A little bit overbought on the short-term move, under accumulation down here. Still one of my favorite sectors, and I think that we can, I think Procter & Gamble would be a buy in here off of this low. Okay. Next question over here was opinion of Valiant or best communication stock. Okay, Valiant. It's so beat up. It's hard to tell. You might give that some room. I think it's probably so oversold that if you're looking for a quick trade on Valiant, you can probably jump in there and pick some up for the longer term. They do have a good pipeline, but I honestly have to say that I don't follow that as much as I probably should. I've been traveling the last 2 weeks, so just from what I've heard on from Jim Cramer, or whatever you want to say, I think he was saying that he would pick it up. The communication stocks, telecommunications have had a good run in here. That's another question. If you look at some of these telephone stocks, AT&T, some of the stocks with good dividends, I'm bullish on that. As long as you're at 0 to minus interest rates, dividend stocks, especially things like stocks that are in good favor, that are paying a good dividend. Stocks like Intel, it's in the technology sector, which is up 10%, having a great run. And it also pays you about 3.5%. I would like that. But here's a question about Exxon and Chevron. Okay, so we go into a sector that I don't like. Over his term, the energy sector is run kind of stalled out over here. Just by here, you had a fall off over here yesterday, and again you're down today another 1.5% to 65.50. So you're down here right on the 50-day moving average on the energy sector right now. A break below that would tell me that you could see a rollover that on that. If you look at Exxon, there's no denying on this up-down ratio chart that you've had a lot of buying going in here. You've gone from about 69 on the big sell-off day up here around 82. Part of that is due to the dividends. Pays a 3.5% dividend. We're back up here bumping into resistance, 200-day moving average. If you can clear that, you might get a little bit higher. But the thing about Exxon, just remember that their earnings are coming out on Friday. They're probably going to be good, but you have to look at the expectations. What do they expect going forward? As long as the oil's down here at 43, 42, 41, if it even goes lower than that, Exxon's not out of the woods yet. You're going to have some big spikes like this because it's so oversold. But again, when we talked a week or the last couple of weeks, I said I would probably sell into resistance. We're at resistance on Exxon, and I'll also probably Chevron. Let's see, CVX. Yeah, we're right at resistance on that. So if you're buying these oversold sectors that we talked about, you're at resistance. I'm probably a seller in here of a minimum, at least half a position, hoping to buy it back down here around 81. Okay, we have next one. Comment on MU. PE 6.7. What do you look for the buy opportunity? Okay. Micron had a nice little spike over here, pulled back. I'm not sure when the earnings are coming up. RSI has gone negative. Up-down slope is so-so. You have support in here around $16. Today we are at, I have Apple up here. Apple ought to give the thing a little bit. You're up at 16.66. I think probably with Micron, you can buy up here around right above 16. This area 16 and a quarter, 16 and a half. I would put a sell stop in down here. If it breaks below the 16 area, you could get hit again. It's not one of my favorite in this sector. I believe some of these other ones, like again, I love Intel, NVDA. Some of these I don't have a list of. I wasn't planning on talking about that many individual stocks. There's a lot of if you go into the industry group on Market Edge, click on semiconductors and related. There's a lot of stocks in there that is going to tell you what our recommendations are, what stocks we're long on. I think you can find some great ideas on there. I still like the sector, especially some of the bigger ones. Okay, what about Europe? Okay, let's look at some of the ETFs in Europe. Here's some of the international emerging. Here's the let's see here. If you give me a second, let me go over into the ETF Center. Here we are. Okay, developed countries. Okay, as far as the different ETFs go, Austria right now has been upgraded to a long. According to this, some of the best performers are the Netherlands, France. They're all getting ready to get upgraded. Here's the S&P 500. It's lagging the S&P 500. Of course, if you have additional quantitative easing, of course these markets are probably going to go up a little bit higher. Japan, Germany, France, Netherlands. You can find which countries are going to outperform in the ETF Center in Market Edge. And I think that you could play some catch-up ball on some of these developed countries and some of the emerging markets. Okay, now look over here. Consumer discretionary. I like that sector also. I'm a little bit more selective on the stocks in that. And we've been talking about Home Depot is one of my favorites. Lowe's, I think, also has a chart that I think you're going to see start to break out. Here's that. You're up here challenging your new highs. Resistance will be at the old 52-week high. You've had a great little rise off that. The 50-day came down here. It's bouncing off of the 200. Again, it's bullish. The up-down ratio, I don't see as much accumulation as I'd like to see, but I think that's because people are a little bit more selective. Alta Saloons, ULTA looks good. Home Depot looks fantastic. It's making new highs here on that. Another one I like, Lowe's. It's kind of have a little bit of a double top here. We can see a Lowe's breaks above this 74, 75 area. You could get a move to new highs on that. I like the relative strength in that. So be selective. Again, if you can go to the industry group and look up some of the specialty retail industry groups, I think you're going to find a list of which stocks are outperforming. You want me to do that real quick to show you where it goes. Go to industry group, go to all groups, hit relative strength over here. It's going to tell you which are the strongest. Right now, other recreation, which would be Disney and some of these, tobacco, beverages, water utilities, savings and loans, gas companies. Retail, specialty retail. Let me see here. Okay, here's some especially retailers would be here's Pep Boys, Manny Joe. We've got a long on that. A score of 0, which means it looks good. Costco, we've talked about that over the last couple of weeks. Love that. Love Home Depot. Lowe's looks good. AutoZone also looks good. There's Alta, neutral from a void. We're seeing that pick up. These industry groups not only are going to find that again it's an improving industry. If you go to the improving and strong industry groups in Market Edge, it's going to tell you which stocks to buy, and it's going to allow you to buy, to pick up some of the strongest stocks and the strongest sectors. That's exactly where you want to be. FireEye. I know it's way down. Okay, not the best looking chart on FireEye. Where it's going to bottom, I don't know. That whole sector is gone. I think from what I understand, Palo Alto is the leader in that group. Until you see the leaders turn around, which I guess FireEye is one of the leaders, but Palo Alto Networks is the leader. When you're looking for a bottom in some of your secondary stocks in a beat-up industry or sector, wait for the leaders to turn. When they turn and start moving up, that's when you'd want to go into this. Is it oversold? Yeah, but I don't see a lot of buying going into it. You've got a lot of this is a broken stock right now. Until you at least see a double bottom or a rounding bottom, you should wait to buy on this thing. I'd wait to the sidelines. Stocks like this, you're better off buying at 32 as it's breaking above resistance than you are catching a knife down here at 28. So I would, I don't know what it's doing today, but I would wait on the sidelines on these. Check the leaders out, and that would be Palo Alto. When it turns, you could think about going into this or maybe even that Barracuda. Okay, we went a little bit longer. We had a lot of good questions. I appreciate that. I hope you got something out of today's meeting. We'll be here next Tuesday. Pay attention to the FOMC results tomorrow. That could be a market mover. If she's too hawkish, the market's probably going to sell off. If she comes in, she's too dovish. We could go sideways to start to another leg up. So thanks again, and there will be a recording of this on the website. And also, if you have any additional questions, send them to support@marketedge.com, or if you want to go to the doc at marketedge.com, you can send them there. Thanks again.